Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. President Trump says he's ready for a legal fight over the future of Fed Governor Lisa Cook, while the Fed itself says it will abide by any court decision. French-German bond spreads risk further widening. Businesses look for predictability and French assets retreat after the Prime Minister called a no-confidence vote. Plus, Asia tech stocks gain ahead of the results from the world's most valuable company. Nvidia's earnings will be a key test of Wall Street's faith in the AI boom.
In the meantime, a quick check on these markets here. Green on the screen, marginally. We were higher just 30 minutes ago. Futures, Euro Stoxx 50 futures higher by 0.2%. NASDAQ futures were roaring 30 minutes ago. They've already paired their gain. If you're looking for some sort of prep, some bracing for Nvidia, that's where you're going to see it ahead of those earnings. $0 at 116. The dollar is driving the trade this morning to the upside. You're seeing it in gold as well. Those intraday charts really showing up. The countdown to the opening trade starts right now.
The Fed will abide by any court decision.
Thank you very much.
Will you abide by a court decision?
I abide by the court, yeah. I abide by.
AMH, Anne-Marie Hordern, Bloomberg's AMH, talking to the president yesterday about what is happening with Lisa Cook and the Feds and independents. Now, normally today, I'd be starting the show off and talking about it being Nvidia Day. But it isn't Nvidia Day just yet. It still feels like it's bond market day. And the bond market on both sides of the Atlantic has a lot to think about.
Yeah, absolutely. Investors increasingly or continuing to think about the long end in particular, whether that's 10s or 30s, thinking about how high those yields go, getting a little nervous about Fed independence, of course. But I think what we learned in the last 24 hours, and that exchange added to that we just heard there, was that this isn't going to be over very quickly. President Trump is ready for some kind of legal fight. The Fed itself said it'll abide by any legal decision. So this is going to the courts. This doesn't get fixed in minutes. This takes some time. And the bond market will be watching.
The bond market will be watching. There's two things from yesterday's exchange that really struck out to me. The first is that he mentioned housing. He said we're going to get a 4-person majority and housing is going to swing. I thought it was funny because it's the same day that the Case-Shiller data came out on terms of housing. And we are seeing a deceleration across the state. So that's one piece of it. The other piece is I'm still trying to work out why he went after Lisa Cook specifically. If the idea is slower, easier monetary policy, Lisa Cook is one of the doves on the board. So what's the logic there?
I don't know, but the housing side, I think, is fascinating, considering what is happening at the 30-year.
Yeah.
The U.S. housing market works off the 30-year. The danger is that the 30-year goes up. He's trying to force the 2-year down. That works over here. It doesn't work over there. Yeah,
absolutely. And that's some of our reporting making that very point, that President Trump is endangering the goal he's going for. He's going for lower rates. But with these threats to Fed independence and the fears around inflation that creates, that pushes up the long end, and then that can interfere with the housing market, as you rightly point out. I also thought it was interesting, the housing market, because it was a very blatant admission of what he's trying to do as well, in terms of reshaping the Fed, reshaping the people there. We will have a majority, and then we'll get the interest rates that we're looking for.
We're talking about the spread widening on the different parts of the yield curve. We talk about the spread widening in just housing prices. You're seeing parts of the states where housing is coming down and coming down sharply. And then you're seeing other places like New York City, for example, where they're skyrocketing. So the data already is fairly messy. He was also talking about who a potential replacement could be. And he mentioned Stephen Moran as Moran. Whoever he is, that man, who's already filling in until January for Adriana Kugler. The thinking was, or at least the name he floated, was that would happen. He would just move them around. PIMCO
published a really interesting note about even if people are nominated, they've got to get through the Senate and they've got to get through the Senate committees, and the Senate committees are really tight, and you're gonna have to be qualified. And there's a bunch of people sitting on some of those Senate committees that aren't up for re-election and take the Fed's independence very seriously. And you wonder whether the White House, therefore, will struggle to get some of these people through. So there are multiple fights brewing in multiple different areas, and the market's got a lot to think about. At the moment, though, the market is largely ignoring this. There's a steepening. It's not massive. Like, we're not through 5%.
It's sort of been ongoing, hasn't it, as a sort of a background thinking process. Let's talk about other political risks.
Let's talk about France. Yesterday was extraordinary. So the UK and France being talked about in the same breath, and the IMF was being mentioned. Now, this came after the French finance minister talked about the fact that the IMF maybe called in. Now, he walked that back. I'm not surprised. We have a long history with this kind of thing, and the UK's experience goes back a long way, and it is not a good experience. So let's just walk that one back and park it for a minute and come back to it maybe at a later date. French markets fell pretty sharply yesterday. The equity market was down 1.7. I'm not seeing much of a bounce being priced in first thing this morning. French business clearly has decided that it's going to wait and see what happens on this one. We're going to get a speech by the Prime Minister tomorrow. It's an ongoing story. Here is something that we hadn't priced in for now, but we're having to price in now.
Yeah.
And who knows what this is going to mean? But Carmignac are talking about the Bund OAT spread potentially going to 100. We're at 77 now. So this story, potentially from a market perspective, has a lot further to go.
Yes, because we actually saw quite a lot of stability in the bond market over in France in the early part of yesterday, didn't we? And we were asking, how come stocks selling off quite so aggressively?
Yeah.
But maybe we don't get a continuation of that stability, and that spread has been widening, as you point out. I was really drawn to some of the... You talk about businesses waiting to see if they get any certainty, any predictability here. And it had a nice line in our story on that subject, talking about investment by non-financial businesses over in France has not grown for any quarter since that election last summer. Yeah. And, I mean, there's been a lot of other reasons for businesses to sit on their hands, a whole host of global uncertainties,
taxes
of course, and taxes have been an issue, but there are plenty of homegrown reasons for businesses to be nervous, and this just sort of adds to that sense of uncertainty.
So we're waiting for the bond market to wake up. We're waiting for the stock market to kind of shake out a little bit. We're also waiting for the euro to price this in. The last time that we saw the Haute-Bund spread at like 85 basis points in the last iteration of this political chaos, the euro was reacting more profoundly, and right now we're not really seeing that. It feels like the focus more on the dollar and what's going on with Cook. Let's talk about the other factor today.
Can it be Nvidia Day?
I guess it can. I guess we'll, squeeze that in.
Tomorrow's Nvidia Day in my mind.
Guy says not yet.
Fair enough. Well, it is Nvidia Day in some parts of the world, and these earnings are coming out after the bell. Now, this one's interesting because I don't even really know what's driving the earnings report today. On the one hand, is it just growth? Is it the diversification? Is it the geopolitics and the H20 exposure to China? Or is it still the continued hyperscalers and the orders there? Because we know there's concerns from Apple, Microsoft, et cetera, that are they pulling back on their AI spend, or are they diving in? And Nvidia is very much at the whim.
How big does the beat and raise have to be for the market not to sell, is my question. Expectations are high. You've seen a good run. Do you take profits? How good do the numbers have to be? Not even good. How far beyond expectations do they have to be to you not to sell the stock today?
Yeah, interesting thinking about the timing and when the beats come, when the profits come, when the impressive numbers come from Nvidia. Our colleague Caroline Hyde was talking to an investor from IO Fund overnight, and she was saying if there is a dip, yes, you do buy it, because the performance at Nvidia is going to be second half loaded. So she was saying that Blackwell and Blackwell Ultra, they really ramp up in the second half of the year. And so whatever performance we see now, it is important. It feeds into the return on investment story, of course, but she was saying it's very much going to be back out loaded.
There's this amazing psychology now in markets that I'm not going to sell because there's going to be a dip, and then it's kind of...
I feel like this conversation's a day early.
You're almost kind of front-running a dip by not selling. You're like, there's a dip coming, so I'm not going to sell, and the whole psychology around this is becoming extraordinary.
But there does seem to be this emphasis on not letting a couple of guests and our guests coming up later in the programme, in fact, making this point, don't let the China H20 drama cloud your vision, as you said, of everything else that is going on at Nvidia.
I mean, it's hard to do because so much of the stock is not pricing in what's going on with China. It's pricing in what's coming in, 10 years down the pipeline. That being said, 8% of the S&P 500, 3% of the global stock index. It's not even just the company itself. It's the precedent it sets for the hyperscalers, other chip companies, and then, of course, all your China tech.
It's a big moment. It's a macro moment. Like it's not just a kind of, this is not a corporate report. This is a macro moment. Anyway, we've got plenty to talk about, as we've already indicated. Let's talk about the guests that we're going to be talking about it all with. Haig, Bathgate, Callanish Capital CEO, going to be joining us. Guillermo, Felices, PGIM's fixed income global investment strategist, joining us around the table in London. Louise, Dudley, Federated Hermes global equity portfolio manager, and Clare, Pleydell-Bouverie, Liontrust fund manager, joining us a little later on the show to talk Nvidia, Kriti.
Plenty of data as well. 10 a.m. UK time, Euro area final. CPI inflation going to be hitting the wire, plus an auction over in the States later in the day. 1:30 p.m. UK time is when that hits. The Treasury will be selling $70 billion of those notes. And then, of course, the key one, Nvidia earnings, 11 p.m. UK time. Tune in.
It's going to be fascinating to watch.
Are you staying up to watch the earnings drop?
It's one of those things you wake up. It's like Christmas morning. It's so exciting. First thing you check
Tomorrow's
is what happens.
Christmas morning.
Will there be gifts?
Who knows?
Will we receive a GPU tomorrow morning?
There will be red and green. regardless.
Or the Grinch strike. Who knows? It's exciting stuff. What else do you need to know this Wednesday morning? We're getting ahead of ourselves. We're talking about Thursday already. The US has now imposed 50% tariffs on some Indian goods. The move fulfilling Donald Trump's threat to punish New Delhi for purchases of Russian oil. Some key industries like electronics and pharmaceutical exports are exempt from the levies, but other sectors like textiles and footwear are likely to be hit hard. President Trump has also warned of economic war if Russia and Ukraine don't end their conflict, saying he had very serious consequences in mind if the fighting continues, quote. Trump told a meeting at the White House that it will not be a world war but an economic war, one he said would be bad for Russia. And congratulations are in order for pop superstar Taylor Swift and NFL player Travis Kelce. The pair announced their engagement in a 5-part post on Instagram, captioned, "Your English teacher and your gym teacher are getting married," which I thought was a bit peculiar, but maybe I'm missing something.
You're not into the social piece of this?
No, I am. I'm just the English teacher, and that's the bit that got me. Anyway,
I can't explain American pop culture in 30 seconds. Please. What I can explain is that this is going viral. This is a huge moment. A lot of people. No, I know, but really? a lot of people are cheering on this love story. Yeah. It does have. I'm going to put the Bloomberg spin on it. We've talked about Taylor Swift in the context of inflation and concert tickets and plane tickets to wherever it is you want to see her concert or can catch it. I wonder what this does to the wedding business. I wonder what this does to the NFL business.
That's already cheap. Obviously, the wedding business is already.
And NFL is also obviously discount shopping there. But
Swiftonomics has a lot to answer for, doesn't it? I mean, I remember during the Eras tour when you couldn't move for economics copy, citing Taylor Swift as one of the contributors to some booming economy.
Well, Oasis showed up in the UK inflation data.
Oasis is the new one. And also, for anybody who doubts that this is an agenda item that Bloomberg readers and viewers and listeners are interested in, then at one point yesterday, if you looked at the most read stories on the Bloomberg terminal in a 1-hour period, top was this story about Taylor Swift, and that was set, and then in third and fourth place we had a story about 30-year bonds and the Fed. So just to put it in perspective, even the Bloomberg universe understands the significance of this story.
There is a connection between the two. Inflation, Taylor Swift, inflation, 30-year bond.
I think you're missing a
completely logical connection.
You're missing the message. The message is these two people are adorable, and it's a beautiful love story.
No, Guy says this isn't about love. This is about 30-year debt.
Obviously.
Right. Coming up on the programme, we will have plenty of conversations about Taylor Swift and about long-end bonds. We will talk to Matthias Reschke, who's JPMorgan's head of European investment grade finance. Lots to discuss there about the way that the market is coping with tensions over in the French economy, perhaps. Plus, we'll keep a close eye on French assets after the Prime Minister's announcement earlier this week of that confidence vote. We've seen a couple of days, 2 days of selling of French stocks in particular. We'll talk about that. Up next, markets are relatively calm despite upheaval at the Fed. We will discuss as we wait for the Nvidia numbers. If you have any questions, if you want to get involved in any of these conversations about Taylor Swift or anything else, IB plus BBTV Go is the function to use. This is Bloomberg.
Fed Governor Lisa Cook, her lawyer, has said that they're going to be filing a lawsuit challenging this legal action. What is your response? Are you prepared for a legal fight?
She seems to have had an infraction, and she can't have an infraction, especially that infraction, because she's in charge of, if you think about it, mortgages, and we need people that are 100% above board, and it doesn't seem like she was.
President Trump there speaking to our very own Anne-Marie Hordern in Washington, addressing the comments and the concerns around Lisa Cook. Those remarks, the latest signal, he has no intention of backing down from a fight that sparked concerns that it could threaten the independence of the Federal Reserve. Bloomberg's Balazs Pens joins us from Hong Kong. He's covering the story from there. Balazs, just walk us through this possibility that this firing actually sticks. Where do we go from here?
Well, we're truly in uncharted waters here, Kriti. This has never happened before. A U.S. president never fired a sitting member of the Fed board. And now we are heading into what looks like is going to be a protracted litigation process. And it's going to hinge on whether the president has been able to establish cause to fire Lisa Cook. And it's going to be a question of what that cause actually entails, what the president needs to show to stand up this decision to fire her. In the meantime, Lisa Cook will likely seek an injunction from a federal judge to reinstate her, to let her continue to do her job in the interim while that whole legal process plays out. And that puts the Fed in a very difficult situation right now. Very simple questions like, is she allowed into the building? Does she have access to her office? Can she participate in the next FOMC meeting? So there are a lot of questions here. We can expect a lot of twists and turns in this saga, which will probably feed into volatility and give investors a lot to chew on.
Yes, if the Fed has deferred a decision in the short term on what happens, then these are all very important questions Balázs to be asking. Let me ask you then where this goes from here, about Fed independence, about the bigger picture. President Trump was being really very candid about what he's trying to do yesterday, talking about soon we will have a majority.
Yes, there's no doubt. The president wants lower rates. He's been very clear about that. He's been telling the world in no uncertain terms that he thinks rates should be much, much lower than they are now. And our reporting also shows today that the president's team is also thinking about whether they can make changes in the regional Feds, the regional presidents, if there's any leverage they have there. Look, what we see in the markets is that there's certainly some concern building when we look at the long end of the yield curve. There's some concern building over the direction of Fed interest rates. If the Fed cuts too much or too fast, that might feed into inflation, and that might create fiscal and financial conditions in the U.S. That create more uncertainty. So that's what investors are grappling with right now. That's what we're seeing in the market.
Balázs, thanks very much indeed. Balázs Penn's joining us on what is happening surrounding the Fed. Yeah, there's some market reaction. I wouldn't say there's a great deal of market reaction. The market seems largely to be absorbing this. Maybe concerns surface later. Maybe the Fed independence story is just a sort of slow-boiling story that will eventually boil over. Haig Bathgate, CEO of Callanish Capital, joining us now to discuss. Haig, I'm surprised that the market isn't reacting more to one of the kind of the central foundational elements of global markets. So the Fed is independent, it sets interest rates relating to the economy. It's not a political decision. What are your thoughts on this? Is the market right to be calm?
Yeah, I think the market's probably just a bit tired of this. It's the usual sort of Trump Punch and Judy show, isn't it? I mean, it's no coincidence. This is another selection from the Biden government. And I think, you know, what we've seen with Trump so far is he's sort of saber rattling a tiger on some of these things, and then he backs off if the market does start to take notice. We saw this with Jay Powell when he really started to have a go at Jay Powell and say he should be removed, and the market started to take notice. He then sort of backed off pretty quickly, you know. So I think we've seen this before, time and time again, from Trump. This does seem highly politically motivated.
It does, and that's kind of the problem. Do I need to build a portfolio for a higher level of inflation over the longer period, over the longer term? Because if the Fed is going to be dictated to by the White House, rates are going to be lower. There is the potential, therefore, for inflation to be higher.
Yeah, I think so. Like, I think the market always sort of susses these things out. I mean, we saw it in the UK, didn't we, with the Liz Truss government as well. I mean, politicians will play games to the point that the markets then, are incredibly good at sounding these things out. And obviously, if the borrowing costs for the US rise rather than fall, which would be the ultimate implication of a higher inflationary environment, it would be seen to be letting inflation get out of control. So they would lose control of the yield curve unless they started to use yield curve controls, and that, spell a pretty bad scenario. I mean, the way that we're playing it is we're just not buying government bonds at the moment, particularly at the medium and long dated end. You're not given enough of return for the potential risk. And of course, if the inflation genie is allowed out the bottle, we know from history that that's very hard to get back in. So on all counts, this just doesn't bode well for government debt, both in the UK and the US, I think.
Are there any kind of yields that might tempt you back in, Haig, when we're thinking about what's going on at the longer end of the US curve?
Yeah, I mean, it would have to be substantially higher at the moment, because obviously you can get very good yields at the short end of the yield curve as well. So the thing that you're absorbing if you don't buy the long-dated ones is reinvestment risk. But to me, it's reinvestment risk without return prospects at the moment. So I think, again, the governments have to be really careful what they're doing here, because if they get this wrong, and people do, and the investors really do take fright and just say, look, we're going to avoid this asset class, I mean, that has a pretty profound and detrimental impact on the bond markets at a time where, Western governments can ill afford to be paying even more on their debt at the moment.
I note from your notes ahead of this conversation, Haig, you talk about liking emerging market debt, though. So what is it that you're seeing in EM debt right now that developed markets are not giving you?
I think it's just a valuation gap, to be honest. I think there's a lot more risk in Western markets, and particularly Western government bonds. And there's not the same level of risk in emerging markets, and particularly sort of China as well. I mean, China always gets a very bad press in the Western media, but if you look at the valuations, they are very compelling. And I think we're just starting to see more momentum in the Chinese economy at the moment. You've seen results recently from the likes of Tencent, which have been very encouraging. And of course, the market will move before the economy does. So we just see the risk-return dynamics of that being much more attractive at the moment.
Hey, walk us through the currency impact. I mean, how does that show up at the end of the day when it comes to whether or not you're actually allocating or even increasing your allocation to the EM universe?
Yeah, I mean, that is the one. I mean, that could be the one, problem area. Obviously, what we usually see is when the dollar's under pressure, then that doesn't tend to bode particularly well for emerging markets. So that's something we need to be mindful of. But again, these are dynamics that are playing out in both sides. It's not a case of everybody's going to be running for the safe haven of the dollar at a time that they're running from emerging markets. They're going to be running from the dollar and potentially running from other asset classes at the same time. So again, we don't see this as being the ultimate outcome, because I think the one thing about Trump is he is very aware of what the market does, and he tends to be quite reactive. So I think if we ever get a hint that bond investors in the US are starting to take fright, then he will back off from some of these from some of these stances he's taking at the moment.
So, Haig, we had a guest on talking to us about the corporate credit market in yesterday's show, and he basically made the argument that because fiscal concerns are plaguing really every developed market and arguably emerging markets of the world, the way to expose yourself to credit is not through govies but through corporate credit. Is that a fair analysis?
Yeah, I think that does play through. The problem is that particularly in investment grade debt, you're not really getting enough of a yield pickup. So the headline yield looks great, but the actual spread you're getting is not that exciting. So you're having to go down into lower quality bonds like high yield to really get the yield pickup. So, I mean, and the other thing as well is remember that we're sort of 12, 13 years since we've had any kind of credit crisis at all. And I think if we were going to see a crack anywhere, and if there was going to be a left tail event coming from anywhere, it would probably be in the credit markets or the private debt markets, which we've seen balloon over the years. So, again, we're being quite selective, but we quite like areas of high yield. We're not so excited about areas like, investment grade corporate debt, just because you're not getting enough of a yield pickup. And of course, all of these bonds price relative to the relevant US Treasury or, UK government bond if they're issued in the UK. So they would be affected if we saw a sell-off in the government bond markets as well.
All right. Haig Bathgate, CEO of Callanish Capital, giving us a tour of the world and a tour of all the asset classes. We thank you so much. It's interesting the argument that he's making there, that investment grade credit isn't giving you enough of pickup, so you go higher in the risk premium, which is the same case he's making basically for EM versus developed.
Yeah, so if you're going to you go high yield if you're going in public markets. He's worried about private markets, isn't he? Which is the same comment we got yesterday from our colleague at Bloomberg Intelligence, who was also worried about what we were seeing in private debt markets and all that hides.
A lot of the most riskier stuff is being pushed into the private markets. So you're kind of hiding the problem for a while. But it's interesting that actually people are a bit nervous about triple Cs. You can see that in the spreads as you go up the hierarchy between the various bonds. So, yeah, I'm not entirely sure that people are that focused on that story. Anyway, we're going to talk France next. That's another bond market story. This is Bloomberg.
30 minutes away from the start of the opening trade. When you look at the futures picture, everything's fine. Green on the screen. Everything seems to have recovered from yesterday, or maybe it's just a bounce back. At least it seems when you look at the FTSE 100. The CAC Iran is where the focus, I think, is today, given that the political chaos in France continues. Higher by 0.2%, but again, likely just a rebound from yesterday.
Yeah, we certainly saw some pressure on the banking sector, the insurers and the construction sector in yesterday's session. So we'll see how they rebound, as you say, Kriti, today. Talking about reaction to the French political story, let's have a look at the bond markets. Monday, we saw yields go much higher in France, and then yesterday looked pretty calm. And today looks pretty calm, actually, on French bond markets. Let's get some perspective. We're joined now by Guillermo Felices, who is Global Investment Strategist at PGIM Fixed Income. And Guillermo, very nice to see you. We'll go around the world a little bit, but we'll start with France, shall we? So in terms of where we are on the bond markets this morning, we see those yields coming down just a little bit across the curve, actually, over in France. So if you were to look at the bond markets, you might not think that the Prime Minister has just called a no-confidence vote in himself, which was something that unseated the last Prime Minister and could take us into some more political turmoil. Why are yields as contained as they are in France? Is that the right question?
Yeah, we cannot deny that risks have increased, and the market, clearly showing, some signs of anxiety. But it's nothing that we are not used to when thinking about France, right? So we have a playbook. We went through this last summer, and spreads went all the way to 80, and we're not far from there. So the way we think about it is, this may offer tactical opportunities, but of course we have to be careful because there's, risks ahead as well, right?
Right, yeah, there are risks. So your playbook is referencing last summer where we went to 80. We're at 76.5 on the spread now, front OATs over bunds, of course. So how high do you think it goes? I think we cited one investor saying, look, this could go to 100. That was in some Bloomberg news stories overnight. What are you thinking?
Yeah, you have to be careful. You have to be tactical. But the way we think about it is broader. So, what are we seeing in the Eurozone more broadly and in EGBs in particular? And what we're seeing there is a macro backdrop that is actually quite decent. So we're seeing growth surprising a little bit to the upside, an ECB that is hugely supportive with all the cuts they've done, and then a rates market that has been showing less and less volatility. So that backdrop is good. And then the contrast with the US as well, right? So for global investors who want to invest and diversify out of the US, EGBs actually look quite interesting when you have basically known unknowns, whereas in the US you have clearly other sources of uncertainty that are harder to deal with. And finally, there's valuation arguments also in favor of France and the periphery. For example, you have curves that are significantly steeper than in the US. So
European government bonds are a haven out of treasuries right now, you think?
They are an alternative, and not a haven. I wouldn't call them that, but they are interesting. They are attractive.
Can I just talk about the UK? We'll come on to the States in just a moment. The UK 30-year is at what, 5.6? Mm-hmm. Right, we got to these levels back in April, but we've been on an upward trend. Yep. Do we get to 6? Can I extrapolate? How far do I extrapolate here in terms of where UK gilts are going?
Yeah, I know it's been a tough ride, right? And this has been a story for some time. I think the DMO has been quite smart in terms of reducing issuance at the long end. That's helping a little bit. I think the problem we have in the UK is that we're seeing a very conventional way of dealing with fiscal excess. And we're seeing, bond vigilantes coming in and saying, okay, show me what you plan to do, and then I'll stabilize. And we don't know yet what the government will do. We'll have to wait until the autumn statement.
But if the autumn statement doesn't deliver, is 6 possible? Where does the crisis point come for the UK?
It's hard to pin down levels. The problem is that
does the trend continue?
Yeah,
of yields going higher and higher.
If you don't bring down the debt to a sustainable path, and you don't bring down the deficit, then the market will continue to test, higher levels at the long end. And that doesn't apply just to the UK; it applies to most DM markets.
Shall we make it over to the States now, which is, I feel like, the story that's driving the conversation globally, at least around Lisa Cook. We were trying to work out around the table how successful this idea of having a more dovish policy can work, that Donald Trump may be looking to, whether it's the Federal Reserve, whether it's other policies, pull down the 2-year while is, in fact, steepening the 30-year. Yeah. Just to argue the flip side of this, does he have a point? If the Federal Reserve starts to cut rates more significantly as early as September, could the 30-year ultimately come down? And affect housing prices?
Yeah, so you have two effects, right? So of course, monetary policy is extremely powerful in terms of driving markets and the economy. And if you pin down the front end and you lower it, that will help the economy and that will help asset prices. You're basically bringing down your discount rate. But of course, if the long end is an anchored and going up, or at least staying stable at high levels, then you have also a problem, because that means that financial conditions for some segments of the market are tight. The housing market is the best example. The housing market cares about long rates, and they are still very high. So you have those two effects. If you want your monetary policy path and then your term premium, or the compensation you need to hold long-term rates or long-term debt.
Is the term premium high enough, juicy enough, for accommodating for any sort of risk around the Federal Reserve, yes, and housing crises and recessions and whatever, but also the X date and the fiscal concerns? Is the term premium juicy enough?
Yeah, so again, hard to pin down numbers, but I think the risk is to the upside, right? Because we're seeing very unconventional policy. It's all about uncertainty, and you have uncertainty about inflation because of tariffs. You have uncertainty about fiscal policy, and you have uncertainty about interference, of how the Fed operates.
If we assume that inflation is structurally higher, demographics, climate change, lots of factors kind of coming in. Is what is happening in the States right now, what Donald Trump is doing, a kind of first step towards raising the inflation target? We go from not targeting 2%, but to targeting 3%. And is that the moment at which the market goes, actually, we need to recalibrate here?
Yeah. I think it's the first step in terms of testing long-term inflation expectations,
right,
which so far actually have been very well behaved, at least in the market. But in terms of changing targets, that's something that the Fed takes very, very seriously. They don't really...
Sure. The old Fed, not the new Fed.
But
we'll see.
So the question is really ultimately, how much interference are we going to see from the administration on the Fed? And that's an open question. So we haven't really heard anything about inflation targets yet. But of course, that's a live issue. We need to follow that very, very carefully.
Guillermo, you mentioned how European government debt markets are a good alternative to treasuries if we're concerned about some of that Fed independence conversation. Not a haven, but a good alternative. And where in particular, I noticed that you in our copy, we cite you talking positively about, let me get this in the right order, Portugal, Italy, Ireland, Greece and Spain, which used to spell something rather cruel way of summing up parts of peripheral Europe back in 2011. Are we really in a place where those are the bonds that are most attractive?
Yeah, so all of these bond markets are attractive because of what I said. So if you look at the yield that you get, especially for U.S. investors, if you hedge your euro exposure, you're picking up some yield there because you're a dollar-based investor and interest rates in the U.S. are still higher than in Europe. But crucially, those curves are pretty steep. So they are twice as steep in Italy and France than in the U.S. That's remarkable. And you're rolling down to the ECB depo rate, which is at 2%. So that's significant roll down that you get if you're a long-term investor and you're willing to stomach some volatility.
All right. Guillermo Felices, global investment strategist at PGIM Fixed Income, giving us his view of the bond markets around the world. We thank you so much. Coming up on the program, we're going to be talking a little bit about some of the banking stocks in focus. Deutsche Bank and Commerzbank catching a downgrade over at Goldman Sachs. We'll talk about that and your other stocks to watch next. This is Bloomberg. Welcome back to the opening trade. Lots to digest. There are bond market worries around the world that haven't yet shown up. There's equity market rallies and then corrections, and everyone's bracing for the seasonality of September. And yet, when you look at the speculators, when you look at the hedge funds, everything's kind of fine. I think this is a chart that caught my eye. Our very own Just Menton over in the States pointing this out, that when you look at the net short positioning, when it comes to VIX positions, this is specifically for hedge funds, you actually see them be the most short going all the way back to 2022. Now, I think that's really interesting, given that it's light volume, it's a light liquidity environment, and yet the hedge funds that are making the biggest bets when it comes to things like tech, when it comes to things like even the long end of the curve, they are positioning for the volatility to come down, especially given the fact that a lot of those trade concerns seem to have dissipated from the narrative. And you can see as early as April, that's where those net longs around VIX futures really had kind of a multi-year high. This idea that volatility would persist. Guy, it's a complete 180 when it comes to the hedge fund community.
Oh, we're going to see some volatility a little later on this evening, though. And will that be produced by Nvidia? It is going to be out with numbers a little bit later on, 10 p.m. UK time, I think, after the market close, of course. Traders are hoping the numbers can shore up some fears about AI spending and perhaps confirm the stock market's latest rally isn't just yet another tech bubble. Tom McKenzie's here. How important is this? Are we going to see volatility? What should I be watching for?
I mean, to your point around volatility, traders are pricing in terms of options, potential downside or upside of around 6% at this stage.
Is that normal? That feels like it's normal.
It's quite a normal setup for Nvidia in terms of the potential. You know, it makes up around 8% of the S&P 500 as well. So there's the broader market impact that you obviously know about. Look, I think what we're going to be looking at is, I think we have a clearer steer in terms of what the hyperscalers are doing. That came through in the earnings in terms of the commitment to continue to invest tens of billions, hundreds of billions collectively on data centers and the GPUs which Nvidia supplies, of course. The longer term question is what happens competitively, particularly as those hyperscalers look in some cases to build out their own chip capacity in terms of chip design, but also come under increasing pressure to create and have more efficient AI processes. And then there's the here and now in terms of the geopolitics of China and all the murkiness around what exactly the Chinese market is offering. When you have the likes of Bernstein suggesting, their analysts saying that there's potentially up to $15 billion in terms of cash sitting on the sidelines in China that could be invested in the chips of Nvidia and AMD at a time when we're not quite sure exactly what access they're going to be getting with that H20 chip.
Yeah, and there's huge uncertainty then around China. So you can either say this is all about hyperscalers and China shouldn't be a distraction, or you can really focus in on China. If we are focused on China, I mean, are the answers going to come in the Nvidia report, or do they come from a meeting between Trump and Xi later on this year?
That's probably more likely where the answers come. We got to this point, of course, where the Trump administration has imposed 15% revenue take from sales of these H20s into the Chinese market from Nvidia and AMD. Then China comes out and says, actually, guys, to the big makers, the large language models, and others, the Alibabas of the world, as well as the DeepSeeks, don't buy Nvidia, or at least we have security concerns, look to domestic players. China is threading a fine line as well. They want to have that competitiveness. They want the world's best large language models, but they also want them to be using domestic chips, which aren't always the best. And then, of course, you have Nvidia saying we're designing a new chip for the Chinese market if, of course, which could be impactful if the Trump administration signs off on it. In terms of revenues from the quarter, by the way, we're looking at potentially a 54% increase year on year, $48 billion. They're looking at a margin of a little over 70%, around a little over 72%, in fact, from Nvidia for the most recent quarter. And as ever, it's going to be what Jensen Huang says about the Chinese market, but also the forecast for the upcoming quarter as well.
Isn't it an incredible top-line growth rate for a business this size, isn't it? I mean, just for a moment. I'm sure this time last year we got excited enough about Nvidia, and now even bigger, 50% again.
How much of this, of the kind of, we keep hearing this narrative, and I feel like we've done this for like 2 years now, where we keep hearing that the spending from the Apples, the Microsofts of the world is slowing down, or they're pulling back on data centers, or whatever the narrative is. And then the money keeps getting pumped into Nvidia. Does that persist this quarter? Is it still a game of hyperscalers become key Nvidia customers? Is that the dynamic?
I think that would be the key surprise. The dynamics seem to be that the spend is still there. You had the commitments from the executives. And you're right. Look, we have had reports, haven't we, from Bloomberg and others suggesting that some companies like Microsoft have been scaling back some of their data center spend. But what you got in the most recent quarter was a commitment. We are going to continue to spend on this. And you just look at the sentiment coming through from Mark Zuckerberg of Meta. For him, this is existential. He has to win in terms of the race towards superintelligence, or AGI. You see how much money he's spending on talent. There's no suggestion that Mark Zuckerberg at Meta is pulling back in terms of the spend on the GPUs alongside that talent, and very little real evidence that likes of Microsoft or Amazon are not doing the same thing. There is still that question in terms of when we start to see real evidence of return on investment for the companies that are actually putting products on top of AI.
But that would be a major surprise, I think, if you got real material evidence that the hyperscalers are slowing down. The big question marks seem to be around the China piece, and then longer term, to what extent Nvidia continue to have 90% of the market share.
Right, so there's hyperscaler growth. There's also the addition of sovereigns and what countries are doing around AI and data centres. So we'll look to that for clues on that as well. Tom McKenzie, thank you very much. Bloomberg's Tom McKenzie with the latest on what to watch for around Nvidia. Let's widen this conversation, talk about where we are on these markets in 3 minutes with our Markets Live executive editor, Mark Cudmore. Mark, good morning to you. So this is a big event, of course, for the tech world. It's also a huge macro event. I'm talking about the Nvidia numbers. Still many hours away, but no doubt investors thinking about how they position for such a big event. How are you thinking about the Nvidia numbers to come?
I think it's really important to look at the context of Nvidia earnings 12 months ago. So we came into these exact same 2Q earnings in August at the end of last year. The market had done well. Nvidia earnings beat. They were just brilliant earnings. And yet the stock sold off, I think it was more than 20% over the coming few weeks, dragging the index lower. Now, that's the bearish way of looking at it. Earnings beat, they're brilliant, and still the stock market tanked. The positive way is obviously the stock market then, after slumping into September, then rallied again to fresh records, and now Nvidia stock is way higher again than it was going to those earnings. I think that the kind of important takeaway from all that is that Nvidia is massive for the coming weeks and can really control the short-term narrative. It is unlikely to be the story in isolation which is going to end or turn this market around on a longer-term scale. So I expect today that Nvidia earnings will be very strong. I think Tom's outlined the details very well. I expect it to beat, and I do think we'll probably get disappointing price action afterwards because the whole world's expecting that. They're positioned for that. Kriti observed the fact that the market's a short VIX. We know the market is generally very long, the stock market at the moment, but I don't think that's going to be the thing that derails this market. I think if you want to be very bearish, and I'm not very bearish, the market's traded better than I expected this month. I expected we'd have more weakness, but I think the weak point at some point will come because bonds sell off too much. Long end bond yields go too high, and that's where the real damage comes. But so far, they're only selling off slowly.
What is too much? Is it 5% in the States on the 30-year? Is it 6% in the UK? Kind of what levels are we talking about? How much further would we have to go?
I don't know, Guy. I'm struggling. I think that in some sense, bond yields continue to go higher as expected. I did think they would go higher at a faster pace. I haven't got the quite timing of this right yet, and I haven't worked out. I feel like there's some kind of binary tipping point, which is what you're asking. I don't know what that binary tipping point is. I don't know whether it's one data point. Is it a level? At the moment, we continue to ratchet up pressure, both in the inflation side and just from these positions getting more underwater. When will it spiral? I'm not sure, but of course, this Friday we have inflation prints from all over the world, so we've certainly got a lot of catalysts on the horizon that might be the cause.
In terms of the catalyst, what matters more at the end of Friday? The potential success story of Nvidia or the PCE data that we're about to get?
Yeah, it's a great question. I think important PC data to emphasize, we get inflation all around the world on Friday, and because this is a global bond problem, not just treasuries, we start with Japan inflation that's meant to come down quite a bit. We then get a load of European inflation prints, so it's the whole inflation story. In fact, core PCE is one that we can estimate very accurately, so it's less likely to surprise. I, though, actually think it might be tech that'll dominate the short-term stock sentiment for the next coming weeks.
All right, Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning. You get more analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Louise Moon. Louise.
Morning, Kriti. As you've been saying, tech is the main thing on people's minds this morning. So we're keeping an eye on chip stocks in Europe this morning. We've got Nvidia's earnings later today, second quarter earnings, as you've been discussing, expected to come in quite strong. So we'll be seeing how this filters through into the European market. Asian stocks have been up. There are obviously other factors at play there with China policies, but we're really focusing on some key ones in Europe. So Infineon, ASM, ST Micro. It's been a mixed picture so far this year. Infineon really outperforming, but the other two into the red. So we'll see how this filters through into the European market this morning. So that's a real key one that we're watching. Next up, we're also watching two German banks, Deutsche Bank and Commerzbank. Both have been cut to different different sells and underperform by Goldman, so both cut by Goldman in a note overnight. Essentially, this is on the outperformance so far this year. They've both been significantly outperforming, both up over about 100% so far this year. The analyst did, however, note on wider European banks, he's still a bit more constructive, is a bit more positive, saying that a host of factors present a backdrop which are arguably better than at any point in the past 20 years. But for Commerzbank and Deutsche Bank, both a cut on that front. And then finally, the last one we're really focusing on is Metzler. Not necessarily a widely known company, but one that's recently listed in London, and it's been performing quite well so far. And the key news here is that they might be joining the FTSE 100. So indicative, this might happen. The actual inclusion will happen on September 3rd, if it does, and it would replace Taylor Wimpey, so the home builder Taylor Wimpey, which has been it's had a tough performance so far this year, down 19% or so so far this year. So they might drop down to the FTSE 250. So we'll have to see if this has any impact at open this morning.
Thank you very much, Louise. Louise Moon, our equities reporter, with a look at where we head on these markets from an individual stocks perspective. Looking at the overall futures picture then, I mean, we're up a little, a bit of a bounce anticipated over, well, no, I was going to say on the CAC 40, but actually the better gains might come through from the FTSE 100, so I won't mention that. But we've seen 2 days of selling on French stocks, and things look pretty flat today. Waiting for the next catalyst, perhaps, whether it comes from France, whether it comes from Fed independence, whether it comes from the Nvidia earnings.
France isn't bouncing. That's critical. So it's interesting that the market still doesn't know what to do with this story. Big sell-off yesterday, down 1.7 on the CAC 40. We are not up today, which I think is significant. Any other market around the world, you'd be buying the dip right now. We are not buying the dip yet in French assets. Let's see how the day develops, but we're not there yet by any stretch of the imagination.
Yeah, a bit of deja vu there. But I think if it comes back to tech earnings, there's a few read-throughs you want to keep an eye on, right? You want to keep an eye on DAX, you want to keep an eye on Amsterdam and the ASML read-through. I feel like we struggle every day or every quarter of whether it's Nvidia or TSMC or ASML that has the kind of lead in the global chip story. So lots to watch there. But I think the morning's story is simply that there's green on the screen, not by much, tiny marginal gains, and we'll see if they stick.
Oil, keep an eye on oil stocks this morning. The president wants lower oil prices. Keep an eye on the auto sector as well. It wants to get rid of some of the industry regulation around EVs. The open is next. Wednesday morning, good morning. Let's talk about yesterday. Let's talk about Tuesday and the session that we saw Tuesday and what it means coming into European trade this morning. European equities actually rallied for most of the session, then faded into the close. What is interesting that after that, we did see US markets, equity markets, rallying into the close. So you got a little bit to price in on the upside this morning, which is maybe why, Kriti, we're seeing futures positive in Europe, despite the fact that actually it looks like the CAC 40 is fairly flat.
The party continues. Maybe the party begins in Europe today, at least here in London. The FTSE 100 is the outperformer, higher by 0.4%, which is interesting because oil stocks are in focus. So the idea that you might see oil stocks come down a little bit and actually see the FTSE 100 still weigh this much of a margin is significant. But Guy mentioned the CAC 40, only higher by 0.1%. Not seeing a bounce there, not seeing a bounce really in all of continental Europe, Anna.
Yeah, absolutely. Not seeing a bounce. Let's have a look at where we are on some individual stock names and some sectors that could be in focus given the news flow that we have had. Let's start with Rio Tinto. This is, of course, in the mining sector under a new CEO. And the new CEO is simplifying the company. So 3 divisions, moving some people around. And so we'll keep an eye on that one, see if that one moves at the start of trade. We're also focused on tech stocks. We're working our way towards the Nvidia data release, Nvidia earnings release, and so that will be crucial, both for the company itself, for the tech sector, and as a macro driver of markets, perhaps it often can be, given the size and scale of this particular business. We've seen Chinese tech names doing quite well overnight in the run-up to those Nvidia numbers. So we'll watch European tech companies and keep an eye on Deutsche Bank and Commerzbank, both of them being downgraded at Goldman Sachs. Interestingly, Goldman says they remain constructive on the outlook for European banks, but they are taking this action given the strong outperformance of these businesses to date, Guy.
OK, here we go. Time for the European opening trade. What kind of numbers are we looking at? Well, not too dramatic. Kriti says the party is on. I think the party could be on when it comes to the FTSE 100, but even it is struggling to make initial headway. We are really waiting to see exactly what the CAC 40 does this morning. After dropping 1.7% yesterday, banks certainly took it on the chin this time yesterday. Are we going to see any of that trade reversing in today's session? Stock 600 barely budging, FTSE 100 barely budging. We're looking maybe for the Nvidia numbers a little bit later on. We're still worried about about what is happening at the long end of the bond market, both in the United States and here in Europe, in the UK and over in France. The IBEX is out of the gate, flat as a pancake, as is the CAC 40, the one we've been waiting for. No pickup, no bounce, no buying of the dip in French equities today, despite the big drop that we saw yesterday on the political concerns that are coming out of Paris right now. So that's the picture at an index level. Not much to see here. Below the surface, what is going on? Kriti, sectors.
Well, I think I overhyped the party. I was hoping the stock market would join me in celebrating the Taylor Swift engagement news, but that's not really what's happening this morning. When you look at it from a sector basis, though, commodity stocks, stocks across the board are really the focus. Green on the screen, but again, your major outperformers or index contributors this morning are Shell, BP, Total, Rio, which I think really tells you that those oil stocks are very much the focus. The property sector, or property stocks, I should say, the home builder stocks, that's where you're seeing a little bit of the pain. On continental Europe, though, when you look at the downside movers, Anna, I'm not seeing a ton of thematics driving the trade.
Yeah, it's interesting that nearly all the sectors are in positive territory, isn't it? Because the gains at the overall index level are not huge, up by 0.3% on the FTSE 100, the CAC up by 0.1%, the German market not yet open. But we have nearly every sector in the green, which is sort of quite a casual drift higher for everything, apart from real estate, as you point out, Kriti. And given US futures are almost entirely flat, that's perhaps not a bad performance for European stocks. But basic resources, the best performing sector. The Rio story not particularly cutting through. The sector as itself is as a whole is up by 0.5%. Rio Tinto up by around 0.5%. Autos and parts actually the second best performing sector. So it's a real mixed bag of lots of stuff going higher this morning. It would
why
appear.
is the energy sector higher this morning? I thought the president wanted lower oil prices, not higher oil prices.
And we've got a flat oil price right now at 67.20, so that's not the driver.
So it's interesting to see that actually that's where the market's rotating to. Shell, BP, Total, all those names.
Do you think that's just a catch-up trade to yesterday, though, in the States? Do you think that's what's happening?
Yeah, I mean, Total sold off a lot just for being French, even though a lot of the business will not be very French.
Shell and BP? Yeah. Not entirely sure. Not a lot of Gallic influence there. It's curious to see. What we are not, though, seeing is a kind of buy the dip mentality in French stocks this morning, which I think is interesting.
I think BNP is a great example of that. Yesterday, one of the biggest weights was BNP, and one of the biggest volume movers to the downside is BNP. It is still down today, only down by like 0.2%, so not seeing the same level of sell-off that we saw yesterday, but certainly seeing some pain. So let's get a little bit more analysis here on how all of this shows up in the equity market. Louise Dudley, Global Equities Portfolio Manager over at Federated Hermes, joins us around the table. Louise, we are trying to marry the chaos we are expecting in the bond market, hasn't really shown up yet, but we're seeing it, to what we're seeing in the stock market. Why is the stock market pricing in France, worries in the US, arguably worries here in the UK, but the bond market isn't? Why do you think there's that dislocation?
I think at the moment people are very much wait and see in terms of overall kind of appetite within the market. I think in general, lots of people have got money in the market. People are quite overbought in terms of equities. So there isn't necessarily that appetite to move. There's a lot of uncertainty. The latest numbers in terms of inflation haven't really held up. And so therefore, people are worried about the near-term direction. And I think obviously Nvidia numbers, that visibility, I think, is going to give a lot of confidence in terms of where we are. At the same time, a lot of Europe reliant on China growth as well. You know, we've heard about commodity names doing well. Obviously, a lot of exposure over there in terms of China as a buyer of those materials. That doesn't seem to be coming in. We're waiting for a bit of stimulus from China. So that there is a bit of wait and see at the moment. So maybe that's why we're not seeing these big moves.
You mentioned Nvidia. That's, of course, the story of today and tomorrow as well, if we can get our eyes off the Fed for just a minute. When we talk about Nvidia and the read-through for European stocks, can we just do some scenario analysis here? If it's a good win for Nvidia, does that mean that all the fund flows then kind of flock to U.S. stocks? Or if it's a bad win for Nvidia, does that affect into Europe in some way? What's the read-through of Nvidia into European equities?
So there's obviously some specific European names which will move in line with Nvidia, so the more kind of chip-exposed names. Other than that, I don't see too much. I think, as you say, maybe it's a bit more that people move into the US, that they feel a bit more that US exuberance coming back, and maybe, you know, European earnings last season haven't been as good. Maybe people start to think, actually, we're going to continue to see that overhang coming in. Lots of tailwinds, I think, for Europe, particularly now with this French news. You know, that's not going to help the overall market get higher.
Louise, good morning. Can I ask you about the link between bond markets and equities? We're watching bond markets very carefully, given all of the Fed independence conversations and what President Trump is doing in reshaping and overtly reshaping the Fed. With your focus on equities, then, what are the, when is it that rates start to really matter for equity investors? Guy was asking earlier, is it a rate that matters, or maybe we're talking about a pace of change? What is it that you're focused on?
A lot of the time at the moment, we're looking at that longer term end of the curve number and how that affects the house builders, those interest rate exposed equity stocks. If we were in a more defensive environment, we'd be thinking about, what are the alternatives in terms of kind of bond proxies and things like that. That's not where we're at the moment. It's very much about those interest rate exposed names, utilities, insurance names, real estate, those types of areas. And that's where it's important. And we're looking to see, will that start to go again? And obviously the latest expectations in terms of interest rates set to come down with a bit more certainty from the news from last week.
Right, yeah. So after Powell and his speech at Jackson Hole, you expect 25 basis points of a cut in September, and then you expect a cut every quarter through 2026. That's quite a lot of cutting. Do you think the fundamentals of the US economy justify that? Are equity investors right to be expecting that kind of support?
So I think, to a certain extent, that's where we think the trajectory is. There's always room for things to be delayed. Obviously, the latest kind of inflation numbers maybe take that down a little bit. But in general, we think that's where the Fed should be going. And in general, from what we're seeing at the moment, that is supportive. Maybe those Nvidia numbers today help with that sentiment as well. And we'll start to see that kind of backing onto that confidence trade.
So you think the US economy is going to justify that level of cutting? This isn't you thinking Trump telling the Fed to cut rates, and that's the reason for it?
No, that's absolutely not. Obviously, what we've seen in terms of kind of the latest news is very much unprecedented, and we'll wait and see in terms of how much pushback that gets and the uncertainty. And
how do I know the difference? Considering I'm worried about the data, and I can see the Fed being pushed around quite a lot at the moment. How do I know that the Fed is cutting for the right reasons?
I think the Fed, obviously the transparency that they have in terms of the minutes, in terms of, the metrics that they're using, they're always emphasising, obviously, being data-led, et cetera, et cetera.
Isn't that the old Fed? The Fed that doesn't have political influence in terms of setting interest rates? That's the old model that we're working with. Is there a new model we should be thinking about?
I don't think so. I think, I think the Fed has to maintain that independence, and I think the market does expect that.
And if it doesn't?
And if it doesn't, I think we'll see, what we saw in those short moments when we thought that, we were going to see an ousting of a governor. So I think that uncertainty could lead to, some big shocks within the market. But I don't expect that will happen. I expect that there will be pushback.
OK.
So September's known for sell-offs historically. The seasonality has always been a factor. There's been a question of what that catalyst could be, building on Guy's point and the point that you made as well. If the market doesn't get a cut September 17th from the Federal Reserve, is that the trigger for a sell-off? Is that enough?
At the moment, I guess it seems so likely that we will get some cut in September that perhaps that's hard to kind of forecast at the moment. If that were to happen, that would definitely be a negative for equities, particularly the US equities. Whether, there would need to be other data points that would need to come in, I think, that would mean that we wouldn't get that cut. So we've obviously got some data coming out at the end of this week, so maybe that will give a bit more certainty as to what we'll see in September. But definitely, if we weren't to see that cut, that's obviously not a kind of a risk on trade at that point.
Louise, Kriti was asking you about Nvidia and how that plays into the European space, and it's always kind of tricky to map that, isn't it, the US tech theme. But in terms of the things you're watching for in the Nvidia earnings, it's one business, but it is a heck of a big business, and it has a macro impact, and it gives us so much information about where the AI trend goes. So what will you be watching for?
So there's a couple of things. There's obviously Blackwell, how well that's selling. Then we've obviously got the H20 numbers as well into China and what that visibility looks like. So I think those are the two kind of big areas that we'll see. There's obviously been some big announcements in terms of kind of sovereign AI, and whether any of that kind of spending has started to be a bit more solidified versus kind of recent news that we have will be something else. But in general, it's a case of people are expecting a beat and raise. It's a case of how big. And will that be big enough? And I think, there has certainly maybe been a bit of a build-up coming into the Nvidia numbers. So there is maybe a bit of caution that maybe they're not going to be as blow out as perhaps they have been in recent quarters. There's obviously the margin expectations going forward as well, and whether they think that's going to continue to come down in a more severe way than what we're expecting.
Should we await a dip? It's been a great run. Nvidia's had a fantastic run over the last 2 or 3 months. Do I wait for a dip before putting more money to work? I can see the reasons why people might say, I don't want to sell, but is there a reason to buy at this point, or do you think a better entry point potentially is coming?
I think the reality when it comes to the AI business cycle is that we're still at the start, and we're still seeing a lot of adaptation come at.
So I can still buy at these levels?
I think so, because I think we're still yet to see some of those adoption coming through across different business channels, and I think there's still a lot of spending that's going to happen, a lot of build out that needs to happen as companies mature within that profile. Maybe we're at that little bit where maybe people are questioning the return on investment for AI and what they're getting from it. But I think the reality is that it becomes the new business normal, and there's still lots of businesses who are still getting up the curve on that. So, very much still at the start of that overall business cycle.
Louise, great to see you. Thanks for stopping by to see us. We really appreciate it. Louise Dudley, Global Equities Portfolio Manager, joining us from Federated Hermes. Quick look at the Core 6, what is happening out there. The firm focused this morning on French stocks. There's a couple on the list, as you can see. Schneider coming back a little bit. LVMH is coming back quite nicely, up by 1.4%. Some of the French banks, though, struggling a little bit this morning. Let's deal with the details of what we are watching out there in more detail. Here's Louise Moon.
First one we're watching this morning is JD Sports, a household name known to everyone. They had some earnings this morning. Shares up almost 2.5% on the back of those. They maintain their guidance. Their sales slightly dropped, but they maintain their guidance and they're looking positive ahead. So that's boosting shares this morning for them, up now almost 3%. Next up, Royal Unibrew, which is a beer maker, also has a host of soft drinks. They're up over 2% into the green. That's after their earnings this morning as well. So that's playing into a positive into the market. And then we're looking at Hochschild Mining, listed in the UK, also another earnings this morning. They beat their first half revenue estimates, although shares down 19% now. Their outlook wasn't as positive despite beating estimates. And then finally, the last one we're looking at is the German real estate company Aroundtown, down almost 4% into the red. Their CFO is stepping down, and their earnings also didn't impress the market this morning.
Thanks, Louise. Thanks very much. Bloomberg's Louise Moon with the latest on those companies that are on the move. There weren't that many of them. Is it just me, or is that kind of short? It's not a very busy day for individual corporate earnings news, is it, on the 27th of August?
No, it feels like a top-down rather than a bottom-up kind of a market. We've come towards the end of earnings season. Nvidia kind of is the sort of the bookend to that. European earnings season largely done.
Big themes we're throwing around, but waiting for Nvidia in the next catalyst.
Well, it's also just the last couple of days of the month, so it's just some rebalancing, I imagine, that's also happening in a very light volume, light liquidity
environment. I'm sure somebody's out there. I'm sure somebody's watching.
Well, we hope so.
You do sometimes sense that a lot of people on vacation still. Coming up on the programme, we will focus in on the French story, though, because it has been one that has kept equity markets certainly on their toes. The CAC 40 is this morning up by 0.3%, but that by no means overwrites the losses of the last couple of days. French assets have been under pressure on concerns the government will fall in a showdown over proposed budget cuts. We'll have more next. This is Bloomberg. Welcome back. This is the opening trade, 8:17 here in London, so 17 minutes into a session that shows French assets, well, stabilising. That is a good way to sum it up, because we've seen 2 days of selling in French stocks. Today looks a little bit different, but we still remember the Monday and Tuesday sessions. We, though, see this stabilisation bringing some respite ahead of a key vote next month that could trigger a collapse in the government. For more, we're joined by Bloomberg's French equities reporter Julian Ponthus, who's been keeping us abreast of all of the twists and turns in this story over the last couple of days. Julian, thank you for joining us once again. So talk us through what's happening on French markets then. A bit of a rebound, but nothing compared to what was lost.
I really wouldn't say a rebound given the scope of the losses that we saw the last 2 days. I think the word stabilizing is probably better. To the traders and the investors I've been speaking to, like there's a sense that the CAC could go down to 7,500 points easily, because in the next 2 weeks before the votes, less than 2 weeks actually, there's nothing really that could prop up the market, because when you think of it, there's basically everyone is expecting Prime Minister Bayrou to fail, to lose his vote. And you could say that that's what the market has actually done. It has given a no confidence vote to Bayrou, anticipating that he will fail and that more uncertainty is to come, and there's like nothing on the horizon to change investors' opinion on the matter. So like when you speak to people here, they're a bit concerned that flows that have been coming into European equities, particularly in France, could be starting to make their way out in the fourth quarter if the uncertainty continues. So the main stocks that are hit most are like the banking stocks and the domestic stocks, and so I don't think the 0.3% is changing the grim picture.
Julian, when the French 10-year in this last iteration of political chaos that we saw overtook Spanish credit yields, there was celebration in the streets of Madrid, a real proud moment for the Spanish, just given that there was so much instability in France. Now we're looking at that same moment, perhaps for Italy. What kind of message does that send now that we've been in, I want to say, the fourth iteration of this political turmoil in the last 2 years?
One thing that's really interesting is that French Finance Minister Lombard said, if we get into a stalemate or we lose the confidence vote, like it's possible, then in 2 weeks France will have the same yields as Italy. It was 10 and now it's only 5 bips. So it's like something like 77 against 82 or 83 in the spread versus Germany. So we're getting there. It really looks like we're getting there. I mean, it's more than symbolic, I think. I think it's really, some kind of a game changer. Of course, there's always the risk of reading too much into, a key figure, a symbolic price. But I mean, it's really telling. It is really telling. So my concern, or my intuition is that some people would take it as a benchmark and to reallocate some funds.
Julian, we'll leave it there. Great stuff. We'll continue to watch what happens with a great deal of interest. Julian Pontus joining us out of Paris on what is happening with the French political scene ripping through into these markets. Let's talk about what else we're watching, particularly in the banking sector. Shares of Deutsche and Commerzbank trading lower after Goldman Sachs downgraded the banks. Let's talk about this and all the other stock stories that we're watching so carefully in this sector. Steve Aarons, Bloomberg's EU finance team leader, joining us. Fascinating on a day when I see UBS hitting a 52-week high that these two banks, which have had great runs, are being downgraded. What's the reason?
Well, as you said, they've had a very good run. I mean, Commerzbank is up more than 100% this year to date. Deutsche Bank is up like 90%. It's amazing, really. And people are taking the profits home with them, right? So Goldman is saying this has run its course, probably. Take it easy now on these stocks. They don't have a whole lot more room to run.
So that's the German story. We're also looking at a story out of Italy then, Stephen, which talks about a possible bank tax. I feel like these come up periodically, various parts of Europe, and then either get implemented or are knocked back. What are we expecting to see in Italy?
Yeah, that's right. So Italy, it's got a bit of a fractious governing coalition, and certain people in that coalition, they always want to tax the banks. It's a bit of a variation of tax the rich. Italian banks have been very profitable over the past few years, so there is money to be gained from them. It's currently a discussion. They want to extend an existing law that would ban banks from using their deferred tax assets for a while, which means the tax bill goes up for a certain period of time and boosts the the state coffers. We'll see what happens. I mean, it's a discussion right now. Will it happen? It's a bit up in the air right now.
Stephen, let's continue the tour around Europe and Europe's banking sector if we can. UBS is one of the stocks that are seeing a lot of heavy volume this morning, only higher by 1%. But it's notable because in the last 24 hours, there's been some reporting from you and your team that UBS has been asked by the Swiss ministry to help with some of the tariff conversations with the states. Can you just give us a little bit more insight about how UBS can potentially help?
It's a good question, and I'm not entirely sure if I can give a very good answer because the question is, what can a bank do? The feeling we have is that this is sort of, an outreach by the Swiss government to not just UBS, but other Swiss companies, big Swiss companies, especially in the pharma sector, to see what's the situation, understand what has actually happened in the real economy and the banking sector, two of the biggest sectors in Switzerland, of course. And so just helping them understand what the situation and a potential reaction is, maybe what Switzerland has to offer to the U.S. to get a better deal further down the road.
Thanks, Stephen. Stephen Aarons, Bloomberg's EU finance team leader. Yeah, it's interesting. Is this story just part of an initiative that any government would do, asking the businesses to, come forward and give us your thoughts? Because our story goes on to talk about, away from the financial services sector, that Roche and Novartis, both of those businesses, have already weighed in with their thoughts.
So if I'm Sergio Motti, I'm like, oh, so we're important to you, are we? So how does that's how the relationship works? Okay, after all the grief you've given us recently, in terms of the politics.
Yeah. Do we think the capital requirements, for example, come down if you help with the tariff business? Is that the trade-off you make if you're Sergio or Motti? But they do have a massive U.S. business, and I wonder how this all. To be honest, I don't actually know the mechanics of it, as Stephen was saying. But if you are Sergio or Motti, if you're any bank CEO, do you have a pipeline to the leaders of that country?
Well, you'll have a lot to say on the subject, I'm sure. Interesting then that we do have the banking sector as a whole. So that doesn't include UBS because that's in financial services. But the banking sector as a whole is the weakest performing today, down by 0.7%. And that was the story part of yesterday, wasn't it? It was a French theme to it yesterday. Today it has more of a German theme. Although some of those German banks, Commerzbank had a tough day yesterday on another downgrade. And obviously we were anticipating M&A in the banking sector. And I wonder if that's not happening.
Is the run over? European banks, biggest driver of European equity outperformance so far this year. If the Goldman's note on Deutsche and Commerz is the issue, and you extrapolate it to the rest of the sector, can Europe keep going if the banks don't?
Well, we always thought that the party would come to an end at some point because that outperformance was driven by.
The party was just getting going.
I know. I'm wavering about whether I want to be in on the party this morning. It's back and forth right now. But we did expect the party to end because so much of the outperformance is buybacks, dividends, and in the case of Unicredit and BBVA, a little bit of M&A.
Yeah, and then on the trading side, there was a lot of benefit, of course, in trading divisions across Europe from, just as we saw on Wall Street as well, from the volatility created by a lot of President Trump headlines around tariffs, and that hasn't died down entirely, but the market has become increasingly accustomed to it, perhaps. And so we'll see whether those trading desks can continue to deliver.
We've done a whole main conversation, haven't even talked about the credit space yet. That's the conversation we're going to have next. Our next guest says Europe is on track for near record bond issuance. Matthias Reschke, JPMorgan's head of European investment grade finance, joins the program next. We're going to dive into those credit market dynamics in the investment grade space and the cue they may be taking from govies and the private space as well. Stick with us. This is Bloomberg. Welcome back to the opening trade. About 30 minutes into today's session, I think we went into today's session expecting France would be the underperformer. And don't get me wrong, it's not exactly the outperformer of the day either. Well, it's definitely not the underperformer. It's interesting, the DAX is down about 0.1%. Again, these are tiny moves. But the fact that you're not seeing a bounce back, given that we did see a rally in the States yesterday, the most action you're seeing is in the FTSE 100. But even that's starting to pare some of its opening gains, only higher by 0.2%, Guy.
I wish I could add a clear sense of direction to what you've just given us, but there isn't one. Let me just kind of break down some of the internals we're seeing in the market. Stock 600 higher, 260 lower, 313. That looks like a fairly balanced market to me. If you're looking for a volume pickup, you're not seeing it. The volume is down by around a quarter. We're back to August kind of a market, and I suspect that may be persisting for the rest of the week. Next week may be a little bit different after Labour Day. In terms of the 52-week highs, we talked about the downgrades we're seeing in the banking sector, what is happening in Italy, but Switzerland feels like a beacon of action bottom this morning. 52-week high on UBS. That stock, as you can see, has rallied really strongly over the last few weeks. We were talking about the fact that banks have powered the gains in Europe this year. If we're starting to see that fade, that's a big deal. But we're not seeing it fading in UBS today. As I say, that stock up very, very nicely. Anna, what else we got?
Yeah, let's get an update on some of the other stories that we're covering for you this morning. We'll start with the Fed. The Trump administration is said to be reviewing options for exerting more influence over the Fed's 12 regional banks. It comes as President Trump says he's prepared for a legal fight with Fed Governor Lisa Cook. That's after he moved to oust her from her post following allegations that she falsified mortgage documents. The United States has now imposed 50% tariffs on some Indian goods, the move fulfilling Donald Trump's threat to punish New Delhi for purchases of Russian oil. Some key industries like electronics and pharmaceutical exports are exempt from the levies, but other sectors like textiles and footwear are likely to be hit hard. And French assets are stabilising today, even as the latest bout of political instability endangers the nation's nascent economic recovery. This after Prime Minister François Bayrou called a confidence vote that could topple the government, of course. And Kriti, we talked about this a number of times this morning about how the French story is playing out. It's been a market focus over the last couple of days, certainly from a stocks perspective. Maybe bond markets, though, managing to stay a little calm. Over the last 24 hours, what have we learned? We haven't heard a huge amount of new information about which way the parties are likely to vote. And so I suppose it's kind of as we were yesterday in fearing for François Bayrou and the future of his government.
Absolutely. Well, we're not seeing much market reaction yet in the bond market, as you were pointing out. The open spread, the French-Italian spread, the French-Spanish spread, if you really want to put into it. I mean, these dynamics are fascinating. I wonder how much of a complacency story there is here, Guy, especially when you do look at the spread versus Germany. Carmignac saying it's going to hit 100 or 77 right now.
Is that going to ripple through into what we're seeing in the credit market? I think is a key question. Primary issuance is still looking pretty good. In fact, it's looking really strong at the moment. Yesterday was strong. Today's strong. Are we going to see any impact coming through from what we're seeing in govies, European government bond markets, into credit? Let's try and answer that question. Matthias Reschke is the head of European investment grade finance at JPMorgan. Good morning.
Good morning.
Yesterday was pretty good.
Absolutely.
Today looks pretty good. Primary doesn't seem to be seeing much of an impact coming out of the govie market. Is that the right reaction?
So I think, first of all, what we're seeing is a market that's surprisingly strong with all the geopolitical noise, whether it's in Europe, in the US, tariffs and so on. Absolute levels are almost at historical tights. You know, we see spread levels both in Europe and the US really, can't get much better. But what we are seeing is that investors are becoming ever so slightly more selective. You know, all the deals that we did, and there was 10 billion of supply yesterday, went well. But we saw a really significant amount of attrition as we went through, revising the pricing. So, we went from, Schneider having a 11 billion order book to, in some of the, tranches that weren't performing so well, more than halving, right? So investors are saying, I'm still comfortable, but, there is a sort of limit. And we really went there yesterday.
You've seen this before. You've been around long enough that you understand how the market dynamics work. Kind of what signal do I take away from that? Is this just we're really tight and I'm getting kind of a bit more selective, or is there something bigger here that we need to be paying attention to?
So what's clearly evident is that investors are a little bit nervous about the levels, but at the same time, whether you look into the investment grade market or the high yield market, there's a lot of cash around. So obviously investors need to invest that. But what's very clear is if there would be negative news that would be more substantial than the geopolitical noise.
Give me examples of that kind of news.
So when we had non-farm payrolls in late July, obviously they were disappointing, and then the previous three non-farm payroll data were lowered in terms of what was reported before. The market got worried that that our biggest fear might happen, which is tariffs are going to be negative for the global economy, that the U.S. might go into a recession, which is right now not the base assumption. But we are also relatively early in the whole tariff game. Companies don't really know how to behave. It seems to change every other day what's going to happen. So the real impact hasn't been seen yet. So if we would see a material impact on U.S. consumption, on the economy tailing off further, I think we'd see a real change. Keep in mind, spread levels are about 50 basis points tighter than they were in early April when the tariffs were announced the first time. That's the kind of variance that you're playing with at the moment. And obviously investors are somewhat concerned about that.
So the argument for why perhaps there's this element of resilience or corporate resilience in the States, but arguably in Europe as well, is that there's a lot of liquidity and cash left over from a lot of the record issuance we saw in 2020 and 2021 specifically here in Europe. When it comes to financing conditions, how much of that is kind of the playbook you're seeing from corporates, i.e., if you're expecting more volatility and you're expecting Fed rate cuts and you're expecting more tariff risk, it's better to raise money now to build up that cushion. Is that the thinking?
Absolutely. When you look at what happened in the first half of the year or until now, we are now 4% ahead of last year in terms of issuance volumes. If you look at the dollar, euro, and sterling market, we're about flat for the dollar, but we're about 13% ahead for the euro market. As we have gone through the year, we hit this big hiatus in April. Spreads went wider. Corporates were, okay, I need to see what all this means. They came back pretty quickly, and people were really worried. And you saw a massive wave of issuance in in May, June, and July. And I think we are going to continue with that narrative. Think about the bank sector. Banks are pretty much done with their funding program, for the year. What we're seeing right now is them already going into the market saying, well, who knows how the next 6, 9, 12 months are going to be. I'm just going to continue with my program. When the market is good, I'm going to hit it.
You just did a deal with Schneider Electric that I've heard has gone very well. There is an argument that we've had in the last couple of days from credit guests who are saying that because of the sticky fiscal situation, a lot of the fund flows, as Guy was pointing out, are coming to the corporate credit space as an alternative to that. If that's the case, how low can spreads go? And are you seeing that being reflected in some of the corporate deals like Schneider?
Yeah, so if you look at the Schneider deal, what was interesting, the largest demand was at the sort of at each end of the 4-tranche deal that we did, so at the short end and at the long end. What was particularly interesting was French insurance companies were massive in the 12-year for Schneider, a deal that we priced 10 basis points inside French govies, right? So it's very clear that a globally diversified A-rated names like Schneider Electric, Siemens, the like, that's exactly what people are saying. If I am a little bit worried, especially in the short term of what might happen, that's probably a safer bet. So I'm willing to, pay very aggressive prices on that.
Schneider, a French company, is a better bet than the French government.
Well, in the short term, I guess that's what people are saying. Yes.
And is that does that make sense? Is that a view of the future, Matthias, or the near term at least? Given that post-pandemic, a lot of guests have told us, companies came out of that with pretty decent balance sheets. Governments came out of that without good balance sheets. So it would make sense maybe that companies can borrow at a cheaper rate than a government.
Yeah, I mean, I guess the long-term theory of the risk-free rate being displayed in govie yields and there being a premium for corporates, I think will still hold. Right. I do think that there are certain corporates that don't come often, that have an incredible track record of performance that it might happen. I do think for the general market that theory will still hold.
Talk to me about the role of the private market, because I'm interested when we talk about corporate debt markets being at record tights, and that's obviously comparing it with its own history. But is the public market now what it used to be? Because haven't a lot of names that maybe make it more difficult to borrow just gone to the private markets instead? And so comparing the public market with its own history maybe is a bit more difficult these days?
So the private market certainly is a huge theme. It was obviously initially something that was really dominant in the high yield market, but we're seeing it more and more also, somehow applying itself on the investment grade side. Private credit ultimately, sells itself to its own investors for getting a premium relative to the public market. So if you're a public market issuer and you have great access and your story is good, I think you will still go for the public side. But somebody that needs a little bit more of a tailored solution that maybe has ratings pressure, certain, huge investments where you might want to have them off balance sheet first and bring them back on, I think they are starting to realize that the sheer volume that is available is obviously an option, and it's right to, look at all the options that you have and then decide what's best for you.
You talk to a lot of companies and you talk to a lot of investors. What is their expectation currently of what the tariff narrative is going to look like? Because it feels like over the last few days we've come back to this idea that maybe the impact isn't going to be so great. You smile at me. Well, is that where your head is? Is that where the people you talk to's head is?
I don't know where my head is, but I think that the investor's mindset is clearly that while there will be an impact, we are facing potentially an economic slowdown in the U.S. But I think people are not worried about a real recession. Ultimately, the way I think about tariffs is you have a 10% base layer that obviously they apply to pretty much everybody, and then they have additional ones with certain sectors in certain countries. So right now, add all that up, you're sort of 14, 15%. So the question is, how is that going to be swallowed, right? Is there, at what pace can price increases to the U.S. consumer be pushed through? Clearly not something that the U.S. government wants to see, but obviously something companies will try. Or how can companies, balance out their supply chain over time to swallow all of that? And it seems to be that the market is saying somehow what we're seeing right now is that we can sort of sail through it, maybe at a slower pace, but it's all going to be fine. The question is if that's true.
Do you think it's all going to be fine?
Well, I'm a bit worried, and I think people should take advantage of markets that are pricing in all the good news.
Can we talk about another risk? And going back to Anna's point on private credit, there's an argument for the private credit bulls in the room or in the world that the deals that are creating this private credit boom are insulated and not going to create systemic risk if something goes wrong. From your vantage point, if something does go wrong in the private credit space, if you see a surge of defaults, is there contagion into investment grade, high grade, et cetera?
We're not worried about that in the investment grade space for sure. The question is, at the moment, the numbers sound large, in terms of private credit, but there's still, a relatively small portion of the total market. Obviously, that will continue to grow. But as I said before, the question really is whether, if the narrative for private credit funds is that they're going to produce a premium to what public market funds are producing, then for companies, the cheapest source of funding is still the public market, right? Yeah. So it's always going to be for those companies that need something special, and I think there's a space for it. The question is, how much is that? I'm not going to put percentages on it, but it's going to be a portion of the market. It has a space for it. Is it going to be so large that it causes a systemic problem? I think we'll have to watch it clearly, but it's not something we're worried about at the moment.
Matthias, thank you very much. Really good to see you. Thank you very much for coming in. Matthias Reschke, head of European investment grade finance at JPMorgan. Coming up on the programme, as investors brace for results from the world's most valuable company, yes, we're back to Nvidia, we will discuss the earnings, what to expect. Clare Pleydell-Bouverie joins us, fund manager at Liontrust. A lot to say on the subject of Nvidia, so we'll get into that conversation next. This is Bloomberg.
Nvidia reporting earnings after the market close. We're waiting till 8:45 to get to the story, which tells you just how much other news there is to process. Traders are hoping you can shore up fears about AI spending and effectively confirm that the stock market's latest rally isn't just another tech bubble. Clare Pleydell-Bouverie, fund manager at Liontrust Investment Partners, of course, a key watcher of Nvidia and expert. Clare, this is the story of the A++++ student getting another great report card. How high are the standards right now?
The bar is high, but what's exciting about this quarter is that it's the first full quarter of Blackwell, Nvidia's latest architecture. So we're going to see that in the results, but more importantly, we're going to be seeing this in the guide. What is the demand for Blackwell? Because we've got to remember that every single model on the market today, whether that be from OpenAI, Anthropic, Grok, that's all trained on the previous generation, Hopper. So this is the first time we're going to get a complete view of the demand outlook, because up until now, supply has been a bottleneck. What we know is now the supply chain is humming, so we're expecting a very significant beat and a sizable raise.
How much of this is a question of liquidity at the end of the day? Liquidity versus kind of revenue from China, revenue from other diversifiers, or are we still hyper-focused on the hyperscalers?
So our focus is not on the hyperscalers anymore. We think that forecasting future revenues for Nvidia, looking at backwards-looking hyperscaler capex, is fundamentally the wrong way to be looking at this company, because we're now moving into the next demand waves of AI adoption. The first wave has really been dominated by those hyperscalers, by the cloud service providers. But the next leg is enterprise AI, and that has been the key change in the ecosystem over the past 2 quarters. We're moving from experimentation of AI to deployment at scale. And inference, as a result, is inflecting. Inferences affect the monetization of AI, so you're pulling that ROI spend through. And as that adoption broadens throughout the enterprise, we're going to see less of a concentration in those hyperscalers. Alongside those enterprise and sort of vectors of demand, we've also got sovereign AI, which we think is probably the most overlooked component of Nvidia's future revenue streams, because it's impossible to predict. But this is a $1.5 trillion opportunity.
That's interesting. Why is it more impossible to predict than anything else about AI? Because we've got the hyperscalers, now we've got enterprise AI, and then you add to that the sovereign AI. So this is governments, nations, countries deciding they need data centers and they need to run their own AI infrastructure. Why is that more difficult, Claire, to get our heads around and predict and forecast?
Because of data protection. It's very, very hard to get visibility from these customer demand profiles. What we do know is that Nvidia has got line of sight to 10 projects worth around 10 gigawatts. To put this in perspective, about a gigawatt is a $50 billion opportunity for Nvidia. Now, these are in the planning stages. We do expect these to start to become a material revenue contributor over the next 2 to 3 years. And we're hearing this from every single nation around the world, whether that be Japan, Canada, the Middle East, even the UK here. These are companies recognizing that they need AI to increase the productivity of their nations.
Right, and some of the energy infrastructure they might need might be a little harder to hide. So, I mean, is that something you're concerned about, though, from the sovereign side? How quickly can it expand, or for any AI, anybody who's inferencing using AI? Are you concerned about their energy supplies? Is that going to be the limiting factor, not supply anymore of GPUs?
There are a lot of bottlenecks still. I mean, the chip constraints were the primary factor maybe a year, 2 years ago. Power is probably the single choke point in the supply chain right now that is causing delays in standing up these data centers. You've got Meta even putting GPUs in tents at the moment in some locations in the US because they're having delays in getting their data centers up and running. So in terms of sort of the whole investment opportunity, when you look across the ecosystem, we do think that a lot of these power generation companies, particularly those that can get power very quickly to their customers, thinking about nuclear in particular here, are in a very strong position.
Cooling a tent must be quite hard. A bit of a challenge there. A couple of quick questions. How fast does an Nvidia chip depreciate?
So we don't actually completely know the answer to this, because Nvidia's first generation of chips, Ampere, they're still being used by some customers because the demand is so strong.
Sure.
Hopper is still in use. 5 years is the standard. Now, Blackwell, because the AI workloads running on Nvidia's latest compute architecture are running at incredible speed and performance, and they generate a lot of heat.
Yep.
There is speculation that we could see shorter depreciation cycles, which would obviously be fantastic news for Nvidia.
Bad news for its customers.
Well, they would have to buy more Nvidia chips.
Yes, and the kind of the stock they have will be worth less quite quickly. So from an accounting point of view, quite bad. There's a point at the end of your note which I thought was really interesting. We see no reason to hold Microsoft, Amazon, Google, Apple at present. That's 20% of the S&P we're talking about there in terms of the market cap. How much are these things mispriced?
We think considerably. What you see with every single big technology platform transition is that demands for compute architecture change. And we saw this with the cloud. We're now seeing this with AI. If you think about the traditional hyperscalers, the AWSs, the GCPs, Azures of this world, they are built on traditional compute. They charge a lot of money to their customers for compute network storage. The margins on their traditional cloud businesses are very, very high, and they're able to do this because they bundle in software with it. It's very hard to actually discern what you're buying from these companies. Now, we're now obviously in an era where everyone is demanding accelerated compute infrastructure. So cloud providers that are purpose-built for accelerated compute, think Oracle, CoreWeave, some of these neo clouds, they're offering the ability to run AI workloads 50 to 60% faster, 30 to 40% cheaper, because it's optimized for accelerated compute. So what we're seeing from AWS, GCP, Azure is that they're losing share to these new hyperscalers for AI workloads specifically. But we also think that you're going to see margin compression over the next 5 years, because there is no way that these companies can continue to charge what they are charging for traditional compute in CPU world for GPU workloads. This will take time for this thesis to play out, because we're in an acute demand-supply imbalance. Yeah. So the Azure numbers still look fantastic at the moment. They've obviously got a partnership with OpenAI, which is also helping to prop that up. We'll see whether that relationship continues to hold. But we think that these companies are going to be on the wrong side of this shift over the next 5 years.
Yep. 20% of the S&P. Big margin compression. Wow. OK, we're going to watch that one very carefully. Thanks for bringing that point to us. Clare, Pleydell-Bouverie, thank you very much indeed. Co-lead fund manager at Liontrust Investment Partners. Kriti wants to talk about... No, I'm looking at you, Clare. Kriti wants to talk about Taylor Swift.
The most important...
She's running away. She's literally running away.
You can stay. You can stay. Don't worry. We won't ask you about Taylor Swift.
Here's why. Congratulations are in order for pop superstar Taylor Swift and NFL player Travis Kelce. The pair announced their engagement in a 5-part post on Instagram captioned, "Your English teacher and your gym teacher are getting married. It's cute if you're a Swiftie." Well wishes for the couple are already pouring in online, and even from the White House. President Trump, who has been critical of Swift for endorsing his political rival Kamala Harris, commented on the engagement during a cabinet meeting.
Player. I think he's a great guy, and I think that she's a terrific person. So I wish them a lot of luck.
All right, the words.
He did talk about Taylor Swift first.
Yes, he did.
That might have been lost slightly.
He congratulated the couple. We're very excited for the couple. OT, opening trade. Congratulations. The couple invites them on the show. Maybe after their wedding, they'll join us here on set.
Kriti's hoping for an invitation, clearly. That's what's happening here.
We're going to talk cars later. I don't know kind of how I can follow that, so I'm not going to bother. The CEO of Volvo Cars is going to be joining us very shortly. We're going to talk tariffs. We're going to talk EV production plans. Apparently, European car makers, though, are looking for the opportunity to maybe continue with their original ICE engines. That's the letter that's gone out today. Anyway, that conversation is coming up at 10:40. The Pulse is up next. I hope you enjoyed the show. Lovely day out there. This is Bloomberg.